1 week ago, silver was trading at $32 per ounce. Today, it sits at $79 per ounce. That is more than double in 7 days. This is not speculation. This is not a temporary fluctuation. This is a structural break, the kind of shock that redefines industries, restructures markets, and exposes the limits of governments. Silver is not just another commodity. It is the most conductive metal known to mankind. Electronics, solar panels, electric vehicles, 5G infrastructure, none of these can function without it. Every solar panel manufactured requires 10 to 20 grams of silver. Every electric vehicle uses between 25 and 50 grams. Every 5G tower consumes 3 to 5 times more silver than a 4G tower. Total industrial demand exceeds 600 million ounces every year, and that demand is not optional. It is dictated by the very policies of governments, by the acceleration of technological innovation, and by the structural needs of a modern economy. For 5,000 years, silver has also served as money. Its supply is finite. Only 830 million ounces are mined annually, and growth is less than 2% each year because silver is almost always a byproduct of other metals like copper, lead, or zinc. You cannot simply mine more silver overnight. You cannot print it. You cannot conjure it out of thin air. Industrial demand alone consumes 600 million ounces annually. Investment demand adds another 200 million ounces. That makes total annual demand roughly 800 million ounces. Supply from mining is 830 million ounces. That leaves only a small buffer of roughly 200 million ounces historically filled from stockpiles. But those stockpiles are now depleted. The United States government holds zero silver reserves. There is no safety net. Every ounce counts. Every disruption is amplified. In December of 2024, China announced a new export licensing system to take effect on January 1st, 2026. China refines roughly a quarter of the world's silver supply. The new rules eliminate small and medium exporters. The result is catastrophic. 150 to 200 million ounces of silver that once flowed from China to the West will simply stop. Simultaneously, major banks have spent 15 years quietly accumulating silver, taking advantage of paper market manipulations, crashing prices during thin trading sessions, and buying physical silver at artificially suppressed prices. They paid $920 million in fines, but their total profits exceed $41 billion. By mid-2025, these banks shifted from net short to net long positions, no longer capping prices, but instead supporting the rally. Imagine the perfect storm. China restricts supply, banks hold massive stockpiles, industrial demand accelerates, mining cannot ramp up quickly. Price becomes the only mechanism to ration scarcity. Solar manufacturers are the first to feel the impact. These companies built their businesses on silver at $25 per ounce. 10 to 20 grams per panel meant a cost of $8 to $16 per panel. At $79, the cost has tripled. $25 to $50 per panel. But these companies operate under long-term fixed price contracts. They cannot reprice. Every panel delivered now loses money. A backlog designed to generate $2 billion in revenue could instead produce $500 million in losses. First Solar, trading at $280 in early 2024, could plunge below $100 if silver remains at $79 per ounce. Electric vehicles face the same brutal reality. Tesla uses 25 to 50 grams of silver per vehicle. At $79, the additional cost per Model 3 reaches $86. Multiply that by 8 million vehicles, and annual costs spike $155 million. Tesla trades at 70 times earnings based on 20% growth. If margins compress, the justified multiple falls, and the stock could reprice by 50%. Tech giants like Apple are not immune. Shipping 2 to 30 million iPhones annually, the surge in silver costs from 25 to 70 $9 could add $70 to $175 million in annual costs. Earnings margins compress. Stock valuations fall. 20% just to maintain multiples. 30 to 40% if market sentiment reacts. The broader market feels the shock. Tech, renewable energy, industrials, and materials make up roughly 40% of the S&P 500 market capitalization. If these sectors rate by an average of 15% due to rising silver costs, the S&P 500 falls 6% from sector rotation alone. Rising commodity costs drive inflation. The Federal Reserve holds rates higher for longer. Equity valuations compress across all sectors. Hedge funds short commodities while long equities face margin calls. Forced liquidation triggers further stock selling. A feedback loop develops, amplifying losses across the market. The Nasdaq could fall 20% if interest rates rise another point. Governments are powerless. They can control financial assets, but they cannot control physical commodities when geological constraints bind. The 1973 oil embargo is instructive. OPEC quadrupled oil prices. The United States tried price controls. It released reserves, but they were too small. Negotiations were ignored. Inflation hit 12%, unemployment 9%, S&P 500 fell 48%. The 1980 Hunt brothers accumulated 100 million ounces of silver, pushing prices from $6 to $49. The government could only manipulate margin requirements to curb debt, fueled speculation, not physical ownership. Today, the crisis is different. The shortage is real. It is distributed globally. Industrial demand is non-discretionary. Governments need silver for energy transitions they legislated but cannot access it. Tools fail. There are no strategic reserves. Price controls create shortages. Export controls are ineffective. Mining subsidies take 7 to 10 years. Currency interventions are useless in global markets. Every tool either does not exist, does not work, takes too long, or creates bigger problems. Once a physical shortage binds, the government is largely powerless. Investors are entering uncharted territory. Paper markets, futures, and financial derivatives can no longer contain the shock. Banks holding physical silver now control the flow. They decide when to release, when to hoard, when to profit. Meanwhile, factories cannot substitute silver. Electronics, solar panels, EVs, 5G towers, these industries are trapped. Contracts are fixed. Costs are rising, margins are collapsing. Stock prices, once assumed to grow indefinitely, now face brutal repricing. This is not a theory. This is unfolding reality. Every panel delivered, every vehicle built, every smartphone shipped comes with hidden losses baked in, waiting to surface in quarterly reports. Retail investors, hedge funds, pension funds, everyone is exposed. Margin calls and forced liquidation amplify the effect, cascading across equities, commodities, and credit markets. Inflationary pressures rise. Central banks cannot print more silver. They cannot intervene effectively. Price is the ultimate arbiter. The next moves are dictated by physics, geology, and industrial necessity, not policy. The world is witnessing a structural shock. Governments can legislate, banks can strategize, companies can hedge, but none can create more silver overnight. The crisis will unfold across industries sequentially. First, solar panels and renewable energy companies, then electric vehicles, then consumer electronics, then broader industrial supply chains. Margins compress, stocks reprice, sector indices fall. The S&P 500 reacts, the Nasdaq reacts more sharply. Hedge funds adjust, triggering forced sales. A feedback loop emerges. The longer the shortage persists, the more amplified the effects. Every ounce counts. Every delay matters. Countries dependent on imported silver are exposed. Strategic energy plans, EV production schedules, technology rollouts, everything is threatened. The system is interconnected. Silver is the weak link. Physical supply cannot increase rapidly. Stockpiles are depleted. Paper positions cannot create silver. Price becomes the signal. Profits become the rationing mechanism. Those holding silver stand to profit massively. Those dependent on it for production face losses they cannot absorb. This is how 79 silver cascades through the economy. This is how a single metal, often overlooked, can reshape markets, compress earnings, inflate costs, and stress government policies. This is how scarcity dictates reality. The ripple effects are already spreading through the industrial world. Every sector touches silver, every calculation depends on it, and every margin is under pressure. Solar panel manufacturers are caught in a trap of their own making. Years of projecting growth based on $25 silver blindsided them. Now, with silver at $79 per ounce, every shipment is a hidden loss, every contract a liability. Panels that were supposed to generate $2 billion in revenue now produce $500 million in losses. That is a shortfall no company can ignore. First Solar, Enphase, SunPower, they are all exposed. Their valuations, once supported by growth projections and government incentives, are collapsing under the weight of rising input costs. For investors, the story is clear. Assumptions no longer hold. The price of silver is dictating reality. Every quarterly report will reveal the strain. And it is not just solar. Electric vehicle production is next. Tesla, the world's leading EV manufacturer, consumes tens of millions of grams of silver every year. At $25 an ounce, the cost was manageable. At $79, it is significant. The Model 3, the Model Y, every vehicle built now carries an additional $86 in raw silver costs alone. Multiply that by the millions of vehicles produced annually, and we are talking hundreds of millions of dollars of added expenses. Margins that were once celebrated are now compressed, growth rates adjusted downward, and investor sentiment shifts. Tesla, trading at 70 times earnings, cannot maintain multiples if margins shrink by even a few percentage points. A repricing of 50% is not only possible, it is probable. Tech giants, too, feel the pressure. Apple produces 230 million iPhones a year. The silver contained within is a minor fraction of the cost, but when multiplied by global production, it amounts to tens of millions in additional expenses. Margins compress. Forecasts adjust. Earnings shrink. Stock valuations drop, and with them, confidence across the sector. The financial markets are interconnected, and the impact spreads faster than most analysts can track. Hedge funds that bet against commodities while remaining long equities are particularly vulnerable. Margin calls ripple through portfolios, forcing the sale of equities to cover shortfalls in commodities. As positions unwind, forced liquidation accelerates, further pressuring stocks. This is not hypothetical. This is a mechanical process of the markets responding to a real physical shortage. Inflationary pressures are building. Commodity costs rise, input costs increase, consumer prices adjust. Central banks can raise interest rates to counteract inflation, but higher rates compress equity valuations even further. Investors begin to reassess risk, reweight portfolios, and pull back from speculative positions. The S&P 500, heavily weighted toward tech and industrials, could easily see a 6% correction simply from sector rotation. The Nasdaq, more concentrated in tech, may face even sharper declines. Every ripple of silver scarcity magnifies across the financial system. Governments, meanwhile, are largely spectators. They can legislate, regulate, and issue monetary policy, but they cannot conjure silver from the ground. Strategic reserves are non-existent. Price controls create artificial shortages, but cannot increase physical supply. Export restrictions are ineffective when the nation produces only a small fraction of global output. Mining subsidies take years to materialize, and currency interventions cannot force the metal into supply chains. History demonstrates the limits of governmental power. In 1973, the oil embargo quadrupled global oil prices. The United States tried to impose price controls, release strategic reserves, and negotiate, yet inflation surged to 12%, unemployment rose to 9%, and the S&P 500 fell 48%. In 1980, the Hunt brothers drove the price of silver from $6 to $49 through accumulation. The government could only act on leveraged positions, not on outright ownership. Today, the dynamics are even more severe. The shortage is real, global, and industrial. Governments need silver for energy transitions, electric vehicle adoption, and technology infrastructure. They cannot access it. Every tool available is either too slow, ineffective, or creates unintended consequences. The market is now dictating outcomes. Industrial demand continues to rise. Governments have legislated renewable energy mandates, EV adoption targets, and 5G expansion. These policies force consumption of silver that cannot be met by production. Physical scarcity is binding. Prices spike. Companies cannot pass costs onto consumers immediately due to fixed contracts. Losses mount. Stocks reprice. Hedge funds and leveraged investors face margin calls. Forced sales accelerate the downward spiral. Each sector experiences its own shockwave, yet they are interconnected. Solar and EVs influence supply chains, which influence tech manufacturers, which influence industrials, which feed back into the broader equity markets. Rising silver prices feed inflation, which triggers central bank rate hikes, which compress multiples, which further depress equity valuations. Investors face a double shock, rising costs and falling asset values simultaneously. Those holding physical silver gain, those dependent on it for production lose. The wealth transfer is immediate and brutal. Strategic decisions that seemed rational just months ago are now unworkable. Companies that forecast growth, expansions, and earnings based on $25 silver now confront $79 reality. Every projection must be recalibrated, every valuation reassessed. This is how a metal, often overlooked, exerts influence far beyond its physical weight. Silver scarcity exposes the fragility of modern markets. Paper positions cannot offset real shortages. Stockpiles have been depleted. Banks with massive physical holdings now influence market direction. The flow of silver, rather than financial contracts, determines the cost structure of industries, the margins of corporations, and ultimately, the valuation of entire stock indices. Investors who ignored this metal, who assumed it was a minor input cost, are discovering it is central to the global economy. Industries that appeared insulated are now exposed. Profits that seemed secure are evaporating. Companies are forced to make difficult choices, absorb costs and endure losses, pass costs onto customers, and risk reduced demand, or halt production and disrupt supply chains. Each decision has cascading effects. Consumers may face higher prices. Suppliers experience delayed payments. Distributors face interruptions. The feedback loop touches every corner of the industrial ecosystem. International trade flows, already complicated, become more strained. China's export restrictions exacerbate the problem. Countries that relied on Chinese refined silver find supply blocked or severely limited. Industrial plans based on assumptions of steady supply must be altered. Governments may attempt to negotiate, lobby, or incentivize, but physical constraints dominate. Mining production cannot be increased overnight. New mines take years to develop, permitting is slow, and geological limitations are fixed. The world is witnessing a fundamental rebalancing. Prices are no longer marginal. They are essential signals of scarcity. Those holding silver physically, strategically, and globally will determine the pace and nature of industrial activity. Those dependent on it without access will face structural losses. This is the new reality. Financial derivatives, futures, and speculative positions cannot substitute for physical scarcity. Contracts can be written, hedges executed, but physical metal cannot be manufactured. This reality will reshape investment strategies, corporate planning, and government policy for years to come. Silver, often overlooked, is now central to the global economic system. Industrial demand, banking strategy, geopolitical constraints, and investor behavior converge. The result is a perfect storm. Companies that once seemed invincible are exposed. Markets are forced to repricing. Inflationary pressure escalates. Central banks react, but physical scarcity dominates. Investors are forced to adapt or face losses. Margins collapse. Contracts are broken. Backlogs turn into liabilities. The entire system, from mining to manufacturing to finance, is in flux. Silver is no longer a simple commodity. It is a central pivot point around which industries, markets, and nations must now rotate. Banks holding physical silver have become the unseen puppet masters of the market. Their accumulation over 15 years, once invisible to most investors, is now the fulcrum on which industries and markets pivot. They purchased at suppressed prices, often when paper markets were manipulated to keep silver cheap. They paid fines along the way, but their profits, in the tens of billions, have been astronomical. By mid-2025, they shifted from net short to net long positions. No longer attempting to suppress prices, they began supporting the rally. This means that every ounce released, every ounce held, every move they make now determines industrial costs, corporate margins, and ultimately stock prices. Imagine the power in that. Imagine the leverage when one metal can determine earnings for entire corporations, the viability of supply chains, and the valuation of major stock indices. Meanwhile, industrial demand continues to accelerate. Governments around the world are mandating energy transitions, EV adoption, and 5G rollouts. The demand for silver is baked into law, into policy, into infrastructure plans that cannot be delayed. Solar panels, electric vehicles, smartphones, 5G towers, all are dependent on silver. Each disruption has immediate consequences. Solar companies cannot pass costs to customers due to long-term contracts. Every panel produced at $79 per ounce now represents a loss. Every EV built carries hundreds of millions of dollars of additional costs. Consumer electronics giants face similar pressures. The market is a web of dependencies. Inflation is rising. Commodity costs are higher. Central banks respond with higher rates, compressing equity valuations further. Hedge funds facing margin calls must sell assets to cover obligations. Forced liquidation spreads across markets. Stocks drop. Indices adjust. The feedback loop amplifies itself. Governments watch, powerless. They have no silver reserves. Price controls are ineffective. Export restrictions matter little when a country produces only a fraction of the global supply. Mining subsidies take years to affect production. Currency intervention cannot create physical metal. The lessons of history are clear. In 1973, the oil embargo quadrupled prices. Governments tried everything: price controls, strategic reserves, negotiations, but failed. In 1980, the Hunt brothers' accumulation of silver drove prices from $6 to $49. The government could only act on leveraged debt, not physical ownership. Today, the shortage is real, global, and industrial. Governments need silver to fulfill the very policies they legislated. They are reliant on supply they cannot access. Every tool at their disposal is inadequate. This scarcity is not speculative. It is physical. It is structural. Investors, companies, and governments are now participants in a market dominated by reality. Profits are concentrated among those who hold physical silver. Losses are unavoidable for those who depend on it for production. Solar companies see their margins collapse. Backlogs of expected revenue turn into losses. EV manufacturers face hundreds of millions in additional costs. Tech companies absorb costs in billions. Hedge funds and leveraged investors are squeezed, triggering further asset liquidation. Inflation rises, rates rise, equity multiples compress. Every sector is touched. Every projection is disrupted. The global economy reacts in real time to the scarcity of one metal. Supply chains adjust slowly. Mines cannot increase output quickly. Stockpiles are gone. Paper positions cannot substitute for physical ounces. Prices are now the ultimate signal. They ration scarcity. They determine which companies can survive and which cannot. They dictate investor profits and losses. This is a systemic shock that spreads far beyond the silver market. It is an industrial shock, a financial shock, a geopolitical shock. Countries reliant on imported silver face disruption. Manufacturing schedules, technology deployments, energy projects, all are threatened. Companies must decide absorb losses, pass costs to consumers, or reduce production. Each choice cascades downstream. Consumers face higher prices. Suppliers see delayed payments. Distributors experience interruptions. The feedback loop touches every corner of the industrial ecosystem. Financial markets respond mechanically. Margin calls, forced liquidations, rebalancing of portfolios amplify the shock. Equity indices fall. Valuations adjust. Central banks respond, but cannot alleviate the underlying scarcity. The next few quarters will reveal the extent of the damage. Earnings reports will surprise, sometimes drastically. Investors will recalibrate risk models. Industries will face forced repricing. Growth projections will be slashed. Silver, once considered a minor input, now dictates the pace of industrial activity and market performance. Every ounce matters. Every delay costs money. Every strategic decision is now constrained by a finite, irreplaceable metal. Governments attempt intervention. They legislate, they negotiate, they offer incentives. Yet physical constraints dominate. Mining production cannot increase overnight. Permits take years. Geological limits are fixed. The system is undergoing a fundamental rebalancing. Prices are no longer marginal signals. They are essential, urgent, and binding. Those who hold physical silver now control the outcome. Those dependent on it without access face structural losses. Industrial demand, banking strategy, geopolitical constraints, and investor behavior converge in one unstoppable force. This is the reality of 79 silver. Companies once thought insulated are now vulnerable. Stocks that seemed secure are repricing rapidly. Inflationary pressures accelerate. Central banks react but cannot create more physical supply. Investors are forced to adapt or accept losses. Margins collapse. Contracts are broken. Backlogs turn into liabilities. Supply chains are disrupted. The system, from mining to manufacturing to finance, is in flux. Silver has become central to the global economic system. Industrial demand, financial manipulation, and physical scarcity dictate outcomes. This is not a temporary phenomenon. It is a structural shift. Profits and losses are now dictated by reality, not speculation. Every industry connected to silver, solar, EVs, tech, industrials, is experiencing the consequences. Every market participant is impacted. Every projection must be reconsidered. This is how scarcity shapes markets. This is how one metal can dominate global economic outcomes. The world has never faced a situation quite like this. Physical constraints, industrial necessity, and strategic accumulation converge. The ripple effects will last for years, shaping industries, redefining valuations, and reshaping government policy. Silver is no longer just a commodity. It is the central pivot point of modern industry, finance, and economic strategy. As the silver crisis unfolds, the full scale of the impact becomes impossible to ignore. Industries that once assumed stability in raw material costs now find themselves scrambling to adapt. Every calculation, every budget, every projected margin has been disrupted. Solar panel manufacturers face a crushing reality. Panels that were profitable at $25 per ounce silver are now bleeding money at $79. Every shipment represents a loss, and the backlog of orders, which should have generated billions in revenue, now threatens to erase earnings entirely. Companies cannot simply pass these costs on to consumers. Contracts are fixed, long-term, and legally binding. Absorbing losses becomes inevitable. For electric vehicle manufacturers, the story is similarly stark. Tesla, producing millions of vehicles annually, is now forced to absorb hundreds of millions in additional costs. Margins, once celebrated, are compressed. Growth projections are lowered. Stock prices are repriced. Investors who had assumed stability in cost inputs are now confronting structural losses. Tech companies, too, are facing a new normal. Apple, producing hundreds of millions of devices each year, is seeing costs surge across thousands of products. Each device carries an incremental cost due to silver alone. When scaled globally, this translates into tens of millions in additional expenses, compressing margins and forcing executives to reevaluate strategies. The financial markets are responding in real time. Hedge funds that are long equities while short commodities are being forced to liquidate positions to cover margin calls. The cascading effect hits the broader market as forced selling accelerates stock declines. Indices adjust. Investor sentiment shifts. The Nasdaq, heavily weighted in tech, is particularly vulnerable. Rate hikes by central banks, designed to curb inflation, driven by rising commodity costs, add additional pressure. Higher rates compress multiples. Equity valuations are challenged across the board. Investors face a dual threat: rising costs in production and falling asset values in their portfolios. Governments are powerless. They have no strategic silver reserves. Price controls cannot create supply. Export restrictions are ineffective when a nation produces a fraction of global output. Mining subsidies take years to materialize, and currency interventions cannot manufacture physical metal. The lessons of history are clear but insufficient. The 1973 oil embargo saw prices quadruple. Governments tried everything, but inflation rose and markets fell. In 1980, the Hunt brothers drove silver from $6 to $49. Governments could only act on debt positions, not physical ownership. Today, the scarcity is global, real, and structural. Governments depend on silver for energy transitions, infrastructure, and technology. They cannot access it. Every tool at their disposal is either too slow, ineffective, or counterproductive. The market now dictates outcomes. Physical scarcity drives prices, profits, and losses. Industrial demand, previously predictable, now becomes a source of volatility. Companies are forced to make difficult choices, absorb costs, reduce production, or delay expansion. Each choice cascades downstream. Consumers may face higher prices. Suppliers face delayed payments. Distribution networks are disrupted. The feedback loop touches every corner of the industrial ecosystem. Financial markets amplify these effects. Margin calls, leveraged positions, and portfolio rebalancing accelerate the shock. Stocks are sold, indices fall, and investor confidence wavers. Central banks respond with monetary policy, but cannot affect the physical reality. Silver scarcity dominates all decisions. Physical stockpiles have been depleted. Paper markets cannot substitute for reality. Banks holding massive amounts of physical silver control the flow, determining industrial costs and market valuations. The imbalance between demand and supply has become acute. Every ounce matters. Every delay matters. Strategic decisions, once considered rational, are now constrained by the scarcity of one metal. This structural break is reshaping global finance and industry. Profits are concentrated among those holding physical silver. Losses are widespread for those dependent on it for production. Solar panels, electric vehicles, smartphones, and 5G infrastructure all are affected. Margins collapse. Contracts become liabilities. Backlogs turn into losses. Supply chains are strained. Inflation rises. Interest rates increase. Equities reprice. Every sector is touched. Every projection is disrupted. Every investor must reassess assumptions. The system, from mining to manufacturing to finance, is in flux. Silver has become the central pivot point of the modern economy. Its scarcity, industrial necessity, and concentration in strategic hands have created a perfect storm. Industries once thought insulated are exposed. Stocks are repriced. Governments cannot act effectively. Investors must adapt or accept losses. This is a global structural shock. Every ounce, every shipment, every production line, every corporate decision is now influenced by silver. The consequences will ripple for years, redefining industries, reshaping market valuations, and challenging government policy.